Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hey everyone, I'm Jeremy Szafron. This is Kitco News. Welcome back to our coverage of the Rick Rule Symposium in Boca Raton, Florida. That's been a great show so far. Lots of optimism on the air. And our next guest says, don't expect that to go away anytime soon, but stresses to do your own due diligence. No stranger to our Kitco audience and the man behind this symposium. Let's welcome Rick Rule. Hey Rick, as always, great to see you.
Pleasure to be with you, and thank you for coming down supporting the show. I appreciate that.
Of course, yeah, it's quite the show. I was just talking to you a little bit off camera. There's so much momentum here. Investors seem to be very, very optimistic about the future. Well, tell me why you go through all the work to put this show on.
Well, for one, I enjoy it. I was lucky enough early in my career to benefit from a lot of mentors who spent a lot of time teaching me. And I've decided that towards the end of my career that I would do the same thing. It seems disingenuous to have accepted other people's help and not pass it forward.
Yeah, and you've been doing these CEO interviews. It does seem more of an educational balance, trying to, educate investors as to what to look for.
I would argue that one of the reasons that you find this investor group optimistic is because we've schooled this investor group through the Rule classroom for years as to how to do proper due diligence, which means that they've had better results than other investors, which means they're optimistic.
True. Okay, talk to me about some of the companies that are here, because obviously you're invested in them. And speaking about due diligence, Rick, you're a master of it. You've been in this industry a long time. What do you look for when you're going into those investments?
It's important to note, I guess, that I started my career in credit. I wasn't one of these narrative, unbridled upside investment banker types. I was worried about my downside before my upside. So due diligence has been important to me. In small companies, it starts with people. Most exploration properties are actually liabilities. They're an excuse to spend money with very little hope of a profitable outcome.
Right.
So it's all about people. If you recognize, as an example, that exploration is really a technology business, a knowledge business, then the quality of the scientist and the quality of the process is what is important. You will find, too, this sounds elitist, but it's true, that a small group of people account for a disproportionate amount of the performance. So you try to hang out with people who have been serially successful, and you avoid simultaneously those, and there are lots of them, who have been serially unsuccessful.
Speaking of a lot of them, it's interesting because when you talk to people, a lot of people stay out of the commodity sector because they go, okay, maybe that company doesn't have much. They got cash, they got an overblown share structure, and they pay themselves too much money. How do you stay away from those types of deals?
Well, that one's pretty easy. We have 200 hours of instructional programming at the Rule classroom, but really it gets down to common sense. Read the income statement, read the balance sheet. We had a young man 20 years ago now, an intern who did some work for us, pulling 25 TSXV companies at random. And we found, to our horror, too small a statistical survey to be really real, but the median TSXV exploration company spent 60% of capital raised on G&A. How's that going to work?
How is it going to work? Yeah, it's interesting because when you kind of look at it, I saw you at PDAC last time we interviewed you in Vancouver, and we were getting those all-time highs on the gold prices. We've seen that new level now, 2,300. It's broken out where we don't think it's going to go necessarily below, knock on wood. Talk to me about your forecast here. It's a momentum time.
Well, I need to tell you, I'm always leery about forecasts, particularly mine. I have a belief that gold is going higher because I have a belief that in objective terms, the U.S. dollar is going lower. I should qualify that. I still think the U.S. dollar will likely be the strongest currency in the world, which is to say that in terms of purchasing power, it will fall less rapidly than other currencies. But if you believe, like I do, that the real decline in purchasing power of the U.S. dollar is more like 7.5% compounded than 2.6 compounded, you understand the strength in gold. It was interesting. I was talking to an interviewer yesterday who said, Rick, when do you think the gold price is going to move? And I said, well, in the year 2000. In the year 2000, it was $256. Now it's $2,400. It's gone up in price 8.4% compounded for 24 years. It has been moving. It's done its job. And I think that's what investors need to pay attention to.
True. And this goes back to what you were saying on stage yesterday. I was watching you talk, and you were really trying to let the audience understand that it's like, if you're looking at your stock price every day, don't get into here. What is the advice for people wanting to enter the commodity space?
Well, any space. Yeah. The money in equities is made in the delta between what a company is worth Remember that a share is only fractional ownership in a business. It's nothing else. It's the delta between the value and the price, and then the expected value. In an exploration company, you need to look at their process. If they've done some trenching, as an example, to validate surface sampling, and now they're going to drill for the third dimension. What's the target size they have? What's the probability of success? How long will the test take? How much will the test cost? Yeah. What would be the likely value of the result? What's the probability of that result? You derive then an expected value, and it's the value that drives your decision, not the price.
Right. So just kind of, if you're investing in that company, stop watching it. Well, let them execute. And how many times have you watched the stock price, go down 50% during your investment, 70%? How volatile?
Well, that really depends on my conviction. Yeah. The statistic that's relevant to your audience, and they'll hate it, is that my average 10-bagger or better has required 5 years to come to fruition and has exposed me to at least one, but often two, 50% declines in the share price. If you have done sufficient work on the company, if you've kept up to speed with the company, these price declines become tolerable. If you are uncertain as to your investment, if you haven't done the work, they're terrifying.
How do you manage expectations for investors when they say, gold prices are all-time high, so that means my stock must be going high because I'm invested in a gold company? How do we create the narrative to look at more than just that?
Well, one of the things that you try to do politely is, if they're in the exploration business, say, understand that these people are looking for gold. They don't have any yet. Right. If the price of something that you don't have any of goes up, it shouldn't matter much to the intrinsic value of your investment. Yeah. You have to ground people in reality. I think the other thing is that what you are interested in is shaped by the macro, but how you make money is shaped by the micro. Yeah, you make money at the firm level. You don't make money with big predictions. The second thing about that your audience really needs to understand is, if you are making an investment based on a long-term trend, don't have a short-term strategy. If you think that the copper price could double in 5 years, don't have a 3-week outlook. Don't have a 3-month outlook. Don't have trauma holding a copper stock over a long weekend.
When these evaluations for a lot of these juniors are at the levels that they are you anticipating a lot of M&A from the biggers?
Absolutely, positively, a lot of M&A. Bigger companies, a properly structured merger is a wonderful thing. You reduce general and administrative expense relative to assets under management because you don't need duplicate management. You offer up more opportunity sets for the allocation of capital with a broader base. Larger companies have greater trading liquidity, which means generally higher share prices, which means they have a lower cost of capital in a capital-intensive business. Very, very, very virtuous set of circumstances.
Talk to me about the future. I mean, we had Nomi Prinz on stage yesterday. She was great. We're going to have her on our show. There was a lot of talk about this rare earth metals and the transition, this green and energy transition that's taken place. And it doesn't mean that, obviously silver is going to be around a long time. But some of these rare earth metals, what's the future look like for this business?
I think rare earth business is extremely, the outlook is extremely bright. I would caution investors that it is devilishly difficult to understand. Mercifully, I've been trying to understand it for 30 years. And while I still don't, I know who does. And so I'm able to make a series of phone calls to decipher. It's difficult even to pronounce the names of individual rare earth companies. On a very broad scale, the applications are increasing rapidly, and rare earths seem to be beginning to be understood in a geopolitical context. We haven't looked for rare earths for 30 years. They're not rare. We haven't looked for them because the Chinese have produced them so efficiently and cheaply that nobody could compete with them. Two things on that. The first is that there does seem to be some discussion of geopolitical rather than economic allocation of rare earths. So there are implications for companies in supply chains that don't include China around rare earths. But the second thing is that the Chinese efficiency in rare earths has come with devastating environmental consequences in far western China. And the Chinese themselves are no longer willing to tolerate that. So the price of rare earths is going to increase, not merely because of geopolitical competition, but rather because the Chinese are beginning to employ Western environmental standards in the extraction of rare earths. And that's the game changer that most people don't recognize.
So is the West then in this fight? I mean, China's kind of taken over that battle, but governments are noticing.
Governments are absolutely noticing, and rare earths aren't rare. Any place that you have old Archean rocks, read Northern Canada, pegmatites. We know the geological environments that rare earths exist in. We haven't looked for them because they are too cheap. That's over. I mean, that's over. We have, at this conference, Meteoric Resources, an Australian listed junior, with an enormous rare earths discovery in Brazil. This isn't the last. People need to understand with rare earths, you need to know about the composition, that is to say, which of the rare earth elements you have, and you need to learn about the metallurgy and extraction, which is devilishly difficult. But there are some truisms across deposits irrespective of commodity, which is to say that bigger is better and grade is king. Understand those. Worry less, I would say, about where gigantic deposits are, and worry more about getting gigantic deposits in your portfolio.
You know, you turn on the cable news nowadays, it's filled with when is the Fed going to cut? When's the interest rate? When is this going to happen? How do you bust through the narrative and really invest in a bear market, which we're seeing now?
Well, bear markets are what I like the most. I've learned in commodity style investing, which is most of what I do, that you are either a contrarian or you're going to be a victim. If you're a contrarian, if you're in a market that's out of favor, say uranium in 2022, when I used to pound the pulpit at Kitco, it's difficult to explain to people that they are better off buying something when it's out of favor and cheap than they are after the narrative's been proven by price. For me, it involves 45 years of having that pounded into my head by exposure to reality. Bear markets are the financial term that people would otherwise use for sales. Why would you buy a winter coat for $500 when you could buy it for $250? When a coat's marked off by 50%, people are excited. When a stock is marked off by 50%, people are horrified. All they have to do is give their head a shake. Buy stocks the way they buy coats.
So are we at that low now? I mean, have everyone taken a haircut?
Bottoms. We're well off the bottom.
We're well off.
Well off the bottom.
How do management deal with these evaluations? I mean, cost of capital is so expensive. You don't want to blow up your share structure. What's the deal here? Going to guys like you?
I would argue that the cost of capital isn't expensive. I would argue that the mining industry is over, not underfunded.
Interesting.
I would argue that of the 3,000 junior companies in the world, listed around the world, not just Canada, probably 450 are viable. Therefore, 2,450 are unviable. The fact that they can raise capital at any price means that capital is too broadly available. I have found, despite this alleged capital shortage, I've probably participated in 35 financings in the last 2 years. 28, 29 were oversubscribed and I got cut back. So for high quality companies, for good people, capital's very, very, very available. I'm going to offend perhaps some of your advertisers, but for the lame, the halt, and the blind, capital shouldn't be available.
Yeah, that's an interesting way of putting it, to say the least. Okay, talk to me then about the strategy going forward in terms of what you're going to be doing here next year at the show.
Well, the exhibitors here are always companies that are in my portfolio. We don't let somebody on the floor of this conference in a public company if we don't own them. Sadly, there's no guarantee that because I own it, the share price goes up. But there is a guarantee that the process is honest. I believe that the gold bull market continues. I believe that we're coming into the time in the gold bull market where silver begins to outpace gold. So all other things being equal, you may see an increasing number, as an example, of silver juniors here. But I really believe that size is what matters. So what you're likely to see here, as opposed to other conferences, is very large deposits in commodities that may not be in favor at this conference. Deposits where the value of recoverable reserves and resources exceeds $20 billion. It might be that there be rutile or graphite or copper or zinc but the overall theme is that size matters. What you'll see at my conference too is that I have a different view of political risk than most people. I believe every jurisdiction is lousy, that there are no good jurisdictions. I would rather have a great deposit in a tier 3 country than a tier 3 deposit in what is perceived to be a great country. So you will see more geographic dispersal, and you'll see more frontier and emerging markets represented.
Is that just oversight, regulatory challenges, more costs added on from governments? Is that?
I think a lot of it has to do with the fact that those nations have been much less thoroughly prospected and explored. When I look around the world at the countries that have treated me the best as an investor, from the simple lens of cash in, cash out, the country that stands out around the world to me the best has been Congo. Hard country. The worst, cash in, cash out, and aggravation, was the People's Republic of California, by far. And people would suggest that California is riskless. It's riskless to me because I won't invest there. Yeah. People talk about permitting regimes. The Resolution copper deposit, controlled by Rio and BHP, in Arizona, allegedly a tier 1 mining jurisdiction, has been stuck in the permitting morass for 26 years. And people tell me Sudan is risky.
Well said. Before I let you go, because obviously you're a busy man at this show, we had Keith Neumeyer on, speaking of somebody that you know well. They have their own mint, as it seems. But he was talking more about the institutional money lacking in this sector as opposed to the retail.
Well, I think that's true. The specific gold investor, the activist, has had a very difficult time. They've had a difficult time for 2 reasons. The sector has had difficult performance, really, since 1982. Relative to other sectors. I mean, we had the period 2000 to 2010, which was good, but other sectors were good too. The other thing is that the active gold managers haven't generally beat the indexes of the ETFs. Investors out there are saying, why should I pay 200 basis points to underperform a product that I can buy for 30 basis points? Very valid question. Now, for myself in the large companies, I don't buy the ETFs either. What I believe is that you buy the 5 or 6 best companies in the sector to grab data. In a bull market, I'm willing to underperform the index a bit if I can de-risk it. If I can buy the Francos, the Agnicos, the Wheatons, the highest quality, highest margin companies that are the best capital allocators. Ironically, in a rip-roaring bull market, the more marginal companies do better. I'd rather, at age 71, for the beta part of my portfolio, give up a bit of the upside in return for trading away all the downside risk.
Well said. All right, Rick Rule, appreciate it. Thanks again for having us here.
Thank you for your support of the conference. It means a lot to me.
Yeah, of course. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We'll be here all week with more great content to come. Stay tuned.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.